Today's event will examine the impact of the Tax Cuts and Jobs Act on business taxation, and as a result, where we stand on this question of tax parity. If there was such a thing as a superhero when it comes to the taxation of America's Main Street businesses, it would be the senior senator from Wisconsin, Senator Johnson. We're delighted to have him here today as our keynote speaker. His 11th hour heroics during the Tax Cut and Job Act negotiations helped bring attention to the concerns of pass-through businesses, especially those that are family-owned or closely held manufacturing and other major employers in our country. And he was a voice of reason in the final tax reform conference deliberations. His leadership and that of Senator Daines and Inhofe in particular helped give Main Street employers a fighting chance to compete with the C corporations who are traded on Wall Street. Senator Johnson, thank you for all you've done for Main Street employers and their workers and for being here with us today, and we look forward to your remarks. Senator Johnson.
Well, thank you, Chris, and appreciate the opportunity here. Now, Brian Reardon, I'm not sure if everybody knows who Brian is, but he's head of the Subchapter S Association. He told me I had to be positive. So let me start out on a positive note. The economic news that was reported on Friday I thought was really spectacular. And not so much because of the 4.1%. I mean, that's good news, but I don't get too excited about the quarterly results. But you take a look at what President Obama was predicting for the year. They were looking at about 2.3% growth. That was a new normal, and that was actually above what they were, probably really expecting. And we probably will achieve for 2018 better than 3%. But to me, the most important numbers in that report, really, put it in comparison, President Obama, the last 2 years of his administration, investment in businesses, the non-residential investment, only averaged 0.6% growth over 2 years. In the first 6 quarters of this administration, because first of all, we stopped adding to the regulatory burden, which I'm a former manufacturer. I really think overregulation is a silent killer of economic activity. I think this is the most significant thing this administration has done. We stopped adding to the regulatory burden, rolled it back, brought a little certainty, a little more optimism, and making American businesses more competitive. We have averaged 7.3% growth in business investment. Now, why is that important? Well, that's investment in plant and equipment. That increases productivity. That lays a foundation for future economic growth, which just builds on itself. And from my standpoint, I don't care what problem you're talking about that faces this nation, our debt and deficit, the fact we're housing our military, a host of them. The number one component of the solution is economic growth, and we're finally achieving it. We have proven that the new normal isn't 2% growth, that 3% plus growth is certainly achievable if you just enact the basic policies that are so common sense, get the government out of businesses' lives, have them not have such a negative impact, and how about having a competitive tax system with the rest of the world? So anyway, we achieved that. And I don't think it's a secret that I wasn't a real big fan of the original proposals, because it literally left 95% of American businesses behind. Now, unfortunately, there aren't enough people here in Congress that understood that. I mean, I don't want to throw my colleagues under the bus too bad, but I had to explain to people exactly what pass-throughs were and why it was so important, why this was such a problem in leaving them behind. I mean, I can't tell you how many times I heard, Ron, this is a solution looking for a problem. Or, hey, Ron, for a couple bucks, they can convert to C Corp status. And I would keep saying, you don't want them to do that, okay? So let me, from my standpoint, the way I would have approached tax reform, I wouldn't have called it reform. I would have talked about tax simplification and tax rationalization. It would have been far more appropriate terms to direct our activity. To simplify the tax code, to rationalize it, would have made us more competitive, okay? One of my favorite sayings is all change is not progress, all movement is not forward. Okay, so I mean, reform to me just doesn't have much meaning. One of the things I started to do when I saw the original proposals, because the alarm bells were going off, the House proposal originally, the 70-30, only applied, by the way, to about one out of every 10 pass-throughs. Now think of this. Let's say you have 3 different types of owners. You have an active owner, you have a passive owner, and then let me put it differently. Let's assume you've got a pass-through business that parents have passed on to their kids. You got one of the children, the hard charger, he's the active owner. You got two ne'er-do-wells, playing golf in Bimini. Then you have a severely handicapped child that the parents have established a trust to hold their shares of stock in. Under the original house plan, the only shareholders that got the 25% tax rate would have been the two ne'er-do-wells in Bimini. The active shareholder, the one really driving the business, would get the next lowest tax rate. The person paying the highest tax rate would have been that handicapped child with a trust. Now, how does that make any sense? Both bills create a whole new category of business taxpayer now. And in the back, if you're interested, I've got, these were the charts and information pieces I was presenting at Senate lunch, much to the consternation of my fellow senators. They weren't, I don't think, all that nuts about my little lectures. But one of the things I was pointing out in the original Senate bill, I laid out current law. There are three types of business taxation. C corps, I know you can't see this, but go with me. C corps, then active pass-through owners, and then passive pass-through owners. The tax laws, both Senate and House version, create a whole new category excluded from any kind of tax treatment. The other crazy result of what we've done is, because now you've got this excluded category, we've made the value judgment that if you make your profit off of machinery, you qualify for more favorable tax treatment. If you make your profit as a pass-through industry off of highly paid workers, you don't get any kind of treatment whatsoever. There's no rational basis for doing that. Now, my concern initially, I know you can't see these figures, but if anybody's interested in these, you got them in back, the original sheet and the final sheet. This is the original Senate bill. We started the old tax system with the differential between pass-throughs and C corps with the maximum differential of 7.7% tax rate. 4.2 for active owners, 7.7% for passive owners. The new law, as originally written, increased that differential from 17.1% up to 23.8%. Okay, in the final version, it's 10% up to 21%. So it's still a huge spread. My concern always, with that large differential, the AICPA confirmed this in a letter to me, saying that they were expecting a mass conversion from pass-through to C Corp status. Now again, I have colleagues saying, well, what's wrong with that? I mean, it's their choice. A couple bucks to convert to C Corp. And I kept saying, you don't want them to do that, because just a back of the envelope calculation would have put us losing. I'm going to get the exact figures. These are out there. I had if 10% of pass-throughs converted. These just 10% of the ones paying the maximum tax rate. Okay, so if 10% of those refused to pay an extra 23.8%, that would have cost the Treasury $84 billion over 10 years. If 75% would have converted, it would have cost the Treasury $631 billion. Now, both JCT and Treasury calculated that conversion cost somewhere between 15 and 16.5 billion. Completely unrealistic. So there's probably one or two pass-throughs. If they convert, probably cost the Treasury that much over 10 years easily. So we just weren't being realistic in terms of, what the real effect of this tax bill was on pass-throughs. So, I told Siobhan Hughes when she's interviewing me in the hallway that I wasn't all that nuts about this tax bill, and she wrote a quick little article, and I called her in my office, saying, watch out for Johnson, he may not be a big supporter of this tax bill. So I called her into my office and had an interview. At some point in time, she really realized I wasn't real nuts about this thing. She asked me to ask a question. She said, well, Senator, if you had to vote for this tax bill, would you vote for it? Thought about it 2 seconds, said no. And her eyes got all wide, and she said, can I print that? I said, well, it's the truth. And that began the 11th hour of negotiations. So we were able to narrow the discrepancy, and I think for a host of reasons, because of complexity of converting as well, I don't think you're going to see that mass conversion. But we still have a problem moving forward, which is what this conference is all about. Because we didn't have enough static score. By the way, the 1.5 trillion, I knew we were going to have a problem, because I had my own proposal of taking C corps and turning them into pass-throughs. I think that's still an option. I think it's an option we should explore. Treat all business income equally. Tax it at the ownership level. All kinds of benefits to doing that. But because we weren't going to do, let's see here, I lost my train of thought. I'm talking about conversions. And if we were to pursue that path, rats, totally lost my train of thought. This is embarrassing. Moving forward. We definitely have to solidify the rules, okay? And we've got to be talking about permanence. Based on past experience with making tax reform permanent, or tax rates permanent, the fiscal cliff, we're always carving out that top tax rate, right? That's what's going to happen at this point in time. And if we do that, you are really putting at a huge competitive disadvantage, both domestically and globally, the most successful pass-through businesses. So, again, I would just suggest what we ought to consider is turning C Corps into pass-throughs. With the current structure, based on the current scores, you might actually raise revenue. By the way, it's popular with Democrats. I've talked to, actually had Tim Kaine and Angus King write a very favorable column in terms of my tax proposal, because now you're taxing business income at progressive individual rates. So I don't have a score on this yet. I want to get a score, but I would envision possibly raising revenue from that, okay? And then being able to use that revenue for doing other good things in terms of rationalizing our tax code. So I think that's extremely important. Otherwise, what people are talking about now is making the individual tax changes permanent. You're going to leave those top businesses behind, and I think that would be very bad for our economic progress. So that's basically my proposal here. Right now there is a effort, and I was just interviewed on this, and you're seeing exactly how it's being typified already, about indexing out capital gains from the gain. Again, I think a basic premise of taxation is income is income. I think it's crazy the way we treat capital gains right now. We just pick a number out of the air to kind of make up for the fact that you're taxing inflationary gains. You can index them out very easily, then the leftover gain or loss just treat as ordinary income. I think that makes a lot of sense, but again, what you're seeing in terms of the whole debate on that, the narrative is that's just a huge tax cut for the wealthy. Never mind the fact that in the past where we've actually lowered the capital gains tax rate, we've dramatically increased revenue raised. But again, don't let facts get in the way of good political rhetoric and demagoguery. So again, I truly appreciate what this group is doing. I think there's a lot of peril in the future if we don't adequately address this. I personally think we didn't have to go as far on C Corps. We always talked about lower the rates, broaden the base, right? Well, we lowered the rates. We just didn't broaden the base a whole lot. So one number I could never get out of Treasury is what is the U.S. effective tax rate in corporations? Start at 35%. I do my own calculations because they wouldn't give it to me based on old data from 2013, 2014. It's about 24%. It was about 24%, which implies 23 to 24%. So the value of those tax expenditures is somewhere between 11 and 12% for C Corps. And we took away some of it, but now you're down to 21%. Take 10% away from that. They're literally an effective rate of 11%. We haven't solved the problem in terms of manufacturers being incentivized to move offshore, because there are going to be jurisdictions that are going to incentivize manufacturers to come over there at a very low tax rate. Again, if you tax C Corps like pass-throughs, you tax worldwide income, you've alleviated the whole problem of businesses keeping money parked overseas. So again, I really emphasize as we move forward at whatever tax reform 2.0 is, we really look at simplifying this, and we made our business tax system more complex, rationalizing it, which means treat all businesses equally. So we don't have this problem of what structure and what rate you're going to pay. So I would really urge everybody in this room to look at that, and then look at the reality situation that if we don't do it that way, probably the best we're going to get is we'll make permanent the individual tax rates up to about You know, I think in the fiscal cliff we did it, protected people about 250,000. Might have been a little bit more than that. I think in the end Boehner got more than that. But again, the real drivers of our economy, these very successful pass-through businesses, they'll be left behind, and they'll probably have no choice to convert, which will cost the Treasury a huge amount of money, hundreds of billions of dollars. With that, I'm happy to take any questions if you got any.
We have a microphone. Put your hand up and we'll bring the mic to you.
Hi, I'm Marty Sullivan, the tax analyst, and thank you for the enlightening presentation. During the final hours of the bill, if you will, the predecessor to 199A, we had 448 for small businesses being excluded from the cash method of accounting, and with 1202 small business stock, and there were certain professions that were excluded from that. And on all of those lists, and in the House bill and in the Senate bill, it included architects and engineers, but then in the last minute, architects and engineers were left out of the bill. And I was just wondering if you knew why that occurred.
The arithmetic. And that's, by the way, that's where I lost my train of thought. That's what I was going to go to. Because I had my proposal, I had all these scores. And I knew that $1.5 trillion would not cover the framework. You know, 20% C Corp, 25% pass-through, we just didn't have enough money. Literally, the $1.5 trillion paid for, that's what 20% tax rate on corporations cost, $1.5 trillion. We had no money to do anything else. So if you really take a look at the initial JCT scores, we improved it a little bit. The rest of the tax reform is just rearranging deck chairs in the Titanic. You know, C Corp's got their tax break. Everybody else just got different treatment, greater complexity. Okay, yeah, we simplified it in terms of individual treatment on standard deduction, but it really was rearranging. But that's my problem with this kind of tax reform. It was just reform. It wasn't simplification. It wasn't rationalization. In the end, it was an arithmetic exercise. I was out there messaging very early on, based on that framework, we need a static score of somewhere between $2 and $3 trillion of static revenue loss in order to do what the framework said. I knew we needed that. When McConnell allowed Corker and Toomey to come up with a $1.5 trillion, you know, I knew we were in trouble.
But this
and we were. So the bottom line is, you know, why were trusts excluded initially?
Yeah.
Because it cost money. It was all about a score.
But this exception cost more money. That's why.
Oh, okay. Well, I can't explain that.
But, okay.
Again, I wasn't a real fan.
One more question. If not,
Okay, thank you much.
thank you for coming.
Well, I think now we'll turn to what I would call sort of the meat and potatoes section of the event, or you can call it eat your spinach. But I think we will have an opportunity to answer a number of the questions that the senator posed directly. For Bob's direction, EY has become really what I would consider to be the gold standard in tax modeling here in Washington, and we very much look forward to Bob's presentation. So, Bob, take it away.
Thanks, Chris. Thanks a lot. Well, thank you, Chris, for that endorsement. I appreciate that. Ernst & Young appreciates that. We're here I'm here to discuss some numbers we've run on CMS corporations under the new law under the TCJA. What Congress chooses to do or chose to do with respect to pass-throughs is quite important to the overall economy. As the senator indicated, more than a majority of private sector employees work in the pass-through sector, and a great deal of economic activity occurs through the pass-through sector. I just mentioned that is a distinguishing feature of the U.S. economy. The pass-through sector in the U.S. is actually significantly larger than in many other developed countries, and that's for a variety of reasons, but it does afford companies a lot of flexibility in terms of how they choose to organize themselves. They have choices, and they can take advantage of those choices. And the extent to which the tax system is driving companies in one direction or another is something that we need to pay careful attention to. So with that, I'll dive into some of the numbers. Just a very quick overview. What we've done is we've developed a set of examples to illustrate the impact of the TCJA on C Corps and S Corps The primary measure in which we're making the comparison is an effective tax rate developed to capture the major features of the TCJA, 21% corporate income tax rate, of course the 20% deduction for qualified business income, also the limitation on the deductibility of state and local taxes, and also an issue that's important to the regulations that are now under consideration at OMB is aggregation. How businesses might or might not be able to aggregate income and deductions across business entities with common ownership is a kind of a critical issue, as you'll see. Just so you can know where we're going, what you'll see is we're comparing effective tax rates for S corporations to an average C corporation with average characteristics of a C corporation, and also to an effective tax rate of an S corporation as though we're instead taxed as a C corporation. Now, overarching issues that you want to pay attention to is kind of you'll see the effective tax rates are pretty idiosyncratic depending on the characteristics or the choices or assumptions underlying each example. But you want to pay attention to parity. How do the S corps compare to the C corps in terms of effective tax rates? So that's one big issue. Another big issue, as I mentioned, is aggregation. What happens? What happens if you don't have a good aggregation? What happens to the effective tax rates and the level of tax on S corporation income? And a third issue, which is kind of out there, is obviously what happens in 2026 when the deduction goes away. So those are the kind of three top line issues. As you look at, there will be a lot of numbers and try to present some of the calculations, but those are the three overarching issues. So I kind of already went through this. One thing I would mention is you have a C corporation subject to 2 layers of tax. It's something we reflect, 21% entity level tax. Shareholders, then the corporate earnings distributed to shareholders as dividends are taxed at a top rate of 23.8%. And if the corporate earnings are retained, they would then be subject to a top rate of 23.8% plus deferral of tax depending on the holding period when the shares of stock are disposed of by shareholders. So we have these 2 layers of tax. For C corporations, we don't have that for pass-throughs, just 1 layer of tax, of course. Shareholders of C corporations are much more likely to be tax exempt based on our information, really based on the Congressional Budget Office, which is based on flow of funds data. About 44% of corporate earnings are thought to be held by or received by tax exempts, pension funds, retirement accounts, university endowments, foreign investors. So that's a big issue that creates a wedge or difference. Again, as I mentioned or alluded to, capital gains are taxed upon are received tax deferral. They're taxed when the shares are disposed of. We assume a 7-year holding period based on some data from the IRS on sale capital assets from a few years ago. And that's about a 30% cutback on the top line, 23.8% rate. So S corps, as I mentioned, a number of issues here. One issue is obviously a single layer of tax. The examples are run at a top rate of 37% at the federal level. You have a 20% deduction. Obviously, not all income, not all pass-through income or S corp income receives that deduction. Your professional services firms do not benefit from the deduction. It's also limited to, there's a wage limitation and a capital limitation. Then another factor to consider is C corporations will generally have, their state and local taxes will be deductible. Not the case for pass-throughs if they're over the $10,000 limit. We're assuming state and local, for purposes of examples, that the state and local taxes are over that limit. And then there's the issue of what happens when you have multiple entities with common ownership. Something we'll find out how the IRS and Treasury want to, we'll find out more about that when they release the regs when they come out of OMB. So just to anticipate where I'm going, what we find, and this kind of frames the point of comparison. We look at a couple of different examples here. We look at an S corporation, kind of we'll start down at the second to bottom row, a domestic S corporation that's receiving the full deduction. And then we have a domestic manufacturer with kind of a brother, sister operation, so real estate and manufacturing. And then we have the second to top row, we'll be looking at a domestic retailer with a common paymaster. And then we'll be looking at a domestic S corporation where all of its shareholders are passive. You'll see we're going to get a range of results. For each of those, we'll be comparing them to an average C corporation, and we'll also be comparing them to what the effective tax rate would be if the S corporation were instead taxed as a C corporation, which is slightly different. So for the C corporation calculation, and I'll probably start kind of going through these slides quickly so I can fit the presentation in probably the 7 or 8 minutes I have left out of the 20 minutes. The C corporation, you have entity level tax, 21%, and then from the after-tax proceeds that go to shareholders, they can be distributed as dividends or retained, either taxed as dividends or taxed as gains. If taxes gains, they're going to benefit from deferral. There's going to be roughly a 30% cutback on the top line statutory rates. End of the day, we would add up the entity level tax and the shareholder level tax. Total tax divided by income gives you effective tax rate. And this is the calculation for the average C corporation. We're assuming that 44% of corporate earnings are distributed to shareholders as dividends, remaining 56% are retained. And I think I might have misspoke earlier, we have about 39% of the shareholders are non-taxable or tax exempt. And this gives us, when you run through the numbers with these assumptions, you get 30.6%. Of course, with different assumptions, you get a somewhat different answer. With the S corporation, it's a little bit more complicated flow chart, but you have your pass-through income, and there are a couple of tests. What is your level of taxable income? If it's below a particular level, you get your full deduction. If not, start asking questions. One question is, do you have specified services? If you're a partner at Ernst & Young, you're not going to benefit from the deduction, for example. That's fine, and then you go down, and maybe it's not, but that's the way it works. That's what Congress decided, and we accept that. It is a democracy. 20% of, anyway, then there are a couple of tests. There's the what I call the wage limitation, the capital income limitation, and you're comparing your qualified business income to your level of wages, and then also to adjusted basis and qualified property, the capital income test. And depending on those comparisons, a portion of all or a portion of your pass-through income may be deemed as qualified and benefit from the deduction. And so we have a 37% tax rate. Then you also have the Medicare net investment tax of 3.8%. That's applied to passive income, so we reflect that also. And then you calculate total tax. Total tax over income gives you your effective tax rate. So this is an example of the domestic S corporation that receives the full deduction, and they have under 2018 law $10,000 of income. The way we handle the SALT deduction is we add it back, starting with $9,400 to get to $10,000. They get the full deduction, $8,000. You run through the numbers, total tax liability $29.98, and you have your effective tax rate. You go to 2026 law, the deduction goes away, and you have a 40% tax rate. And you can see the comparison to the C Corp, slightly higher than the C Corp. The S Corp is highly higher than the average C Corp. If the S Corp were taxed as a C Corp, much higher. And there the difference is due to the assumption about tax-exempt investors. When we run the numbers for this S Corp as a C Corp, we're assuming 100% of the shareholders, or 100% of the income is taxable. That gives rise to 36.8. If the S Corp converted and was able to acquire tax-exempt shareholders, you get a different result, of course. So that's kind of one comparison. And then we have a common, what we call a common paymaster, and this is really three entities and kind of in one business operation where most of the wage income resides in one of the three operations, and we call this the common paymaster. Maybe the payroll function is in the one operation, and so when you run the numbers, they're going to get clipped. The QPI is going to get clipped by the wage limitation, and lo and behold, rather than if this were treated as one business operation and everything was aggregated, they would get the full $2,000 deduction for QPI instead, because of the wage limitation and the way the business is organized, that all the wages are in one of the entities, not spread across the three entities. They are going to lose 54% of the deduction, and so that's obviously going to drive the effective tax rate up. So when we run the numbers, if you allow complete aggregation, everything's hunky-dory. You get to the 31.9% we got into the earlier example, but here, without aggregation, you get to 36.2%, considerably higher. Very, very idiosyncratic, depends on how a business organizes its affairs. The next example, we have the brother-sister operation, real estate and manufacturing, and here, the real estate enterprise is going to get clipped by the capital limitation, and this isn't going to get, we have the split 50-50 in terms of the income. You get $2,000 at this full aggregation. Instead of getting the $2,000 deduction, the firm would only get, through the real estate enterprise, only the $463. They lose 27% of their QBI deduction. And lo and behold, they went up with a 34% effective tax rate. Again, if we were to compare this to the average C corporation in 2018, it would be compared to 30.6, 34 rather than 30.6. And if this operation were taxed as a C corporation, we'd be up at the 36.8. Then we have an example where we have passive shareholders, where 100% of the S corp shareholders are passive, and what happens there is the Medicare investment tax is applying to all of the income rather than just a portion, and that gives rise to a 35.5% tax rate. And then all the examples you've seen to this point do not include, they include the SALT deduction, but they don't include state corporate income taxes. If you include corporate state income taxes, you can get a variety of results. It really depends on what state a company is operating in. They may be operating in multiple states. There are zero tax states, which you can think of the prior examples as literally applying to the zero tax states, or they could be operating in California, a very high tax rate state, and you can get a variety of results. This example uses an average 6% corporate income tax, state corporate income tax rate. It's kind of a weighted average across all the states, and you get a somewhat different result. So kind of bottom line is, at least for these examples, it looks like you don't quite achieve parity. When you get it to 2026 law, obviously, that's a huge issue that Congress will need to deal with, and the results can vary quite a lot from business to business depending on how they're organized, how they arrange their affairs. So it is very, very idiosyncratic. Very good.
Thank you, Bob. Sure. Richard did the obstacle course video of what it takes to actually qualify for the 20% deduction, and he gets my nomination for Best Actor, but I'm not sure if it was in a comedy or a drama.
Not an act.
All right. Best Gymnast in a drama. We also have Doug Holtz-Eakin, President of the American Action Forum, former Policy Director for the McCain Presidential Campaign, former CBO Director, and I also got to work with Doug in the Bush administration. Doug is known as a straight shooter who calls it like he sees it, a very rare thing in Washington these days, and he has become an indispensable voice on tax policy. We're very happy to have him with us today. And finally, Brian Reardon is president of the S Corp Association. Brian is also a member of the steering committee of the Parity Coalition. I got to work with Brian when he was across East Executive Avenue in the White House. when he was president, special assistant to the president for tax policy. So we have a great panel, and I'll turn it over to Richard.
Bob's presentation and/or provide some landscape on where we are, and then I'll ask a few questions, and then we'll open it up.
Sure. Thanks, Richard. So Brian Reardon, S Corp Association. We asked Bob to put together these slides, and then we're going to do a paper subsequently to help with the communications challenge that we have, which is how do you take a very complex result of tax reform for passers in particular and articulate it in a clean, concise way so that people understand the challenges that S Corp owners and pass-through owners in general are facing right now. And I thought Bob's slides did a really good job. If you take a look at the C Corp slides, you can see that C Corps across the board get the 21% top rate. And then it gets a little complicated because then they got to pay that second layer of tax. And some C Corps don't pay any second layer of tax. I always think of Berkshire Hathaway. Warren Buffett's never paid a second layer of tax on all that money, and he never will. And then you've got others like utilities down the street, et cetera, where they pretty much have to kick out all of their earnings in the year in which they earn it, to generally fully taxable shareholders. So you've got this wide range of possible outcomes for C Corps. It's 21% at the low end, and it's up around 39% at the top end. And that's the second layer of tax is the complexity for C Corps. For S Corps, it starts right when you're in the money. I mean, all S Corps these days are going to be taxed at 37%, right? Some of them may get the deduction. If you're a specified service business, you don't get the deduction. If you're not a specified service business, you will get the deduction, but it's subject to the guardrails and it's subject to limitation. If you have international income, you don't get the deduction. There are other things like that. If you don't have enough wages, you don't get the deduction. If you're structured wrong, and Treasury does the aggregation rules in a way that we hope they won't, then you won't get the deduction. So it gets really, really complex. I think what I love about that first slide that Bob shows with all the effective marginal rates is that it gives you a general idea that while all the outcomes vary dramatically depending on facts and circumstances, generally speaking, the S Corp down the road is going to pay a higher effective marginal rate than the C Corp down the road. And so the challenge that we face with all that complexity is, okay, how do we take that complexity and turn it into a reasonable and effective advocacy strategy? And so I've got a simple three-step plan here. And step one is, working with Treasury and folks to make sure that the rules coming in Treasury are as good as possible so that businesses that should get the deduction, they actually get the deduction. If you're a manufacturer and you're making stuff here in the United States and you employ people here, you should get the deduction even if you have multiple legal entities and you might have some sort of an aggregation issue. Two, we need to make things permanent. Doug's done some work on that front and I'm sure he'll address it, but the permanency issue is something that people are paying for right now. They're trying to figure out, okay, I want to be an S Corp, I want to get that deduction, but it goes away in 8 years. How am I going to deal with that? And then the third thing is what Senator Johnson talked about, which is one of the reasons I really enjoyed my buddy relationship with him, is he's looking down the road like, okay, what does the real reform look like? How do we get all businesses to a place where you're taxing the S Corps and C Corps, public companies, closely held companies, just about the same. So they're all paying the same top rate, they're all paying it once, they're all paying it when it's earned, and there's none of this complexity like the second layer of tax on C Corps or all the different rules that we're dealing with S Corps. And that's the three-step challenge, right? Get the rules right out of Treasury, work on permanence so we build a foundation for the future, and then figure out what the end game is. And so that's why I thought Bob's slides did a great job of sort of articulating the numbers behind that challenge. And I look forward to kind of continuing the conversation because it's going to be a long conversation.
Thanks. Thank you. I appreciate the chance to be here today, and thank Bob for the presentation and the Senator for his remarks. Just to be clear, what's at stake from a public policy point of view, I've always felt was this persistent poor productivity growth in the United States, which translates into persistent poor growth in real wages and the standard of living. And economists don't know a lot about productivity growth, but to the extent we know anything, it is that capital deepening, having more embedded capital per worker, is strongly correlated with better productivity growth in the data, and that has always strongly been correlated with better growth in their overall compensation. If you looked at, for example, the census data in 2016, the increase in the standard of living for those households that worked full-time for the full year was exactly 0. And that's a public policy problem, something that has to be dealt with. From a tax policy perspective, and then you would want to have the tax code not penalize those things that produce investments in innovation and in capital deepening. And you would like to make sure that when you do that, you take whoever is investing in innovation and investing in capital deepening and treat them the same. And that's the tax policy goal, is to have this sort of nice non-distortionary impact on those kinds of decisions. And that's why you get to see 8 slides with 756,000 numbers on them today, trying to figure out exactly where we are in that quest. And so I want to thank Bob for EY's contribution to this. I'm a big fan of this work. As Brian mentioned, I was interested in another part of the tax policy issue, which is permanent tax policy is always better than temporary tax policy. And due to the constraints of the legislative process and the decision to only lose 1.5 trillion in this tax court, there are a lot of sunsets in this. That's not a good idea, other than being the same. So we asked EY to take a look at what would happen if you took all of the provisions that sunset, expensing and all the individual title provisions, just make them permanent. What goes on? And my forecast is that when you leave, you will get a folder that looks like this. It's probably the only good forecast I'll ever make.
It's solid.
In that folder will be this piece of paper which has the answer to that question, which Bob's group put together. And the answer is that you get, inside the 10-year window and over the long term, increases in aggregate GDP, increases in wages and job equivalents, which means that what we did in the Tax Cuts and Jobs Act was leave something on the table. We didn't really get all we could from a tax policy point of view to address this pressing issue in getting better growth and growth in real wages. And so that's where we are in this debate. And I want to just sort of thank everyone for the sort of going through all this today. I guess the things that I walked away with, there's a couple of questions that I'll just toss out, and Bob can answer them in no particular order. One was, there were no examples with international income, and a big focus of the reform was getting the U.S. to move toward a more territorial system with specific emphasis on having IP and other intangible kind of income located in the U.S. and how does that play out in this C Corp versus S Corp world? I don't know the answer to that, but I've been curious for a while. You have to answer all my questions there. That's the other thing that's going on. Second is, there's a big focus here on average tax rates, this effective tax rate. I'm an economist by training, so I'm always interested in the marginal tax rate. So I take my next dollar and stick it in the C or the S Corp world. With expensing, you expect to get no tax on the normal rate of return. No one's interested in earning the normal rate of return. We all want to excel. So there's still going to be issues associated with supernormal returns. And I just wondered how those look in the S versus the C world. Then I guess I'd love to hear 2 other things that I just don't really know the answer to anymore. When I had hair and was first learning this business, we cared about the tax policy distortion between pass-throughs and C Corps, because C Corps got special treatment. There was limited liability in particular, so that if you ran a C Corp, people couldn't go after your personal assets if you owed money. And that was a particular advantage the C Corps got. And if you had taxes pushing people into C Corps or out of C Corps, you were distorting the risk-taking in the economy, and that was a bad thing. Other things being the same. We now have limited liability corporations. We have limited liability partnerships. We have pass-throughs of limited liability with C Corps. I'm trying to figure out what's really at stake anymore in this sort of entity distortion, and whether there's any real deep economic cost to just having one classification for business taxation. And I'd love your thoughts on that. And the last is, I don't know a lot about the Treasury rulemaking process. I've spent most of my adult life trying not to know anything about it. And but it does seem to me that with this aggregation issue, there's a real incentive to engage in what looks like transfer pricing and start moving stuff in between the affiliates. And that doesn't seem like the kind of thing you want to come out of a tax reform. So what's really at stake in the Treasury 199 process, and sort of how should we think about evaluating the outcome? So I just appreciate the good work.
Yeah,
Bob, lots of good questions.
yeah, Bob, why don't you respond to at least the first couple of those, Jeff,
Okay,
in one
sure.
area.
So we do have some examples for, we do have examples for firms with international income in the interest of time and understandability. I dropped those for purposes of this discussion, and but in the report we will have a discussion of that. marginal effective tax rates, it answers a somewhat different question. I think this gets at kind of some of the, in a more simple fashion, for kind of for non-economists gets at the issue. But I'm also a huge fan of marginal effective tax rates. Marginal effective tax rates kind of drove some of the results in the macro analysis that, or permanence that Doug referenced. You have a lot more hair than I do, Doug. I will point that out. So when you have hair, that's in the eye of the beholder. Going on to the level of, why not one level of tax for all firms? Most economists would view a system where you get to that. We would call it integration, which kills that idea almost instantly. But nevertheless, getting to one layer of tax. But I think what makes this so difficult is that the corporate income tax and the tax on pass-through businesses they really tax different things. You mentioned the supernormal return and the normal return. The corporate level tax, because of the deductibility of interest, is really a tax on equity finance, the return to equity finance investment, as opposed to debt finance investment. Wages are taxed through the wage tax or the individual income tax. Or pass-throughs is kind of a very different animal. And so we have this kind of very hybrid system applying to pass-throughs, and you have to worry about how the return to labor is taxed and how the return to capital is taxed. And that gets into a lot of complexity. And we see that on the slides. We saw that in the discussion of the TCJA as it was being debated, as it evolved through the various proposals. And we've seen that over the longer haul in the tax reform debate going back to the Treasury 92 integration report or beyond that. So that maybe that's enough, yeah. Yep.
So my question for you, Bob, is when I look at these numbers, it looks like there's an advantage for the average C Corp, but it looks to me like the advantage is driven in large part by the fact that C Corps have lots of exempt shareholders, which are pension funds, foreigners, foundations, universities. Should we, from a policy perspective, should we care about that? And if you think about it that way, isn't it really more like pass-throughs have an advantage? Like, how should we think about parity in that context?
Yeah, well, I think aggregation is a big issue, and how OMB decides, or IRS and Treasury, how the regs come out, is a very substantive issue. It is the case that an S corporation could flip to a C corporation, if that was had no transaction costs associated with it. Not so easy to flip. So they might be kind of stuck in the current status. But they would then have to go out and acquire tax-exempt shareholders, right, in order to get the same tax treatment. So you would be having,
No, because their taxable shareholders would be treated just like a C Corp's taxable shareholders. Isn't it just because C Corps tend to operate in equity markets where they're attracting investment from tax-exempt shareholders? That's an artifact of the way they're organized, not necessarily
call it an artifact of their investor base, right? Yeah. Their investor base looks like X. The S corps, they look like Y. They look like they're different for various reasons, and that gives you, that results in two different outcomes.
Yeah, if I could just add to that, so effectively, the C corp cost of capital is less than if you're out there trying to raise money as an S corp. So one of the reasons that S corps have fully taxable shareholders is the law. I mean, they're not allowed to have charities or other folks. So if I'm a C corp and I'm able to go out and access sovereign funds and pension funds and all these folks who don't pay that second layer of tax, so their cost of capital is a lot lower. Their expected return is going to be a lot lower than somebody who's actually going to have to pay tax on that return. Then I'm going to be able to raise a lot more capital. I'm going to be able to raise it cheaper than the S corp down the street. That's a really big long-term problem. And that's one of the reasons that S corps were created in the first place, with the single layer of tax and what Doug talks about, the liability, the umbrella of liability protection, because closely held businesses, and this kind of gets back to one of the things that Doug was talking about, closely held businesses, the way to divide the business community is not big, small, all that stuff. It's closely held businesses who operate with one set of rules and one set of governance challenges, and public companies who are access to public markets and have access to all this cheap capital. That's the line of difference. And the difference extends beyond that. I mean, you've got the SEC regs and all the sorts of things that the public guys have to comply with. But there's an extraordinary difference in the way that a public company behaves versus a private company. And there's an extraordinary difference in the way a private company has to go about raising capital, dealing with shareholders, et cetera, versus a public company. There's an extraordinary difference in the cost or the sale of stock. I mean, if you're a private company, you really can't sell your stock. There's no market for it. Or if you do find a market, you're pretty lucky. Whereas a public company, you're churning the stock all the time. So the cost of the stock is actually higher for public companies than it is for private companies. So that's, in my mind, I always really chafe at this idea of small versus large. It's not, it's closely held businesses versus public companies. That's the line that differentiates the two. And you really can't pretend that public companies and private companies can operate with exactly the same rules. They won't be able to. The public companies will over time take over.
Brian, can you also talk about these aggregation rules and kind of going to Doug's point, like what are you looking for from Treasury in ways that would, you know, try and respect and reflect the existing arrangements that are out there,
Sure.
without necessarily encouraging companies to do, you know, people call it the cracking back, to sort of disaggregate and reaggregate themselves?
No, yeah, I thought Doug raised some very good points. I think from our perspective, you know, sort of a broad aggregation rule would address his concerns. So think about it this way. So my favorite manufacturer out there in Ohio, he employs 300 people. He's got 5 different entities. He has the common paymaster structure that Bob talked about, where all his employees work for one LLC. Right? They're all over here. But there's no revenue going to that LLC. All the revenue is in the other 4 entities that he has. And he has those entities because they're in different locations, because they operate different things, because maybe he's got some different investors. But he's got these 4 or 5 different entities. All of their wages are in one. So if you apply a strict, you're going to have to calculate this 20% deduction per entity, he's not going to get the deduction at all because all his wages are in an entity without any revenues and all his revenues are in entities without any wages. So the wage limitation on the 20% deduction is going to give him a big fat zero. So the question is, okay, does Dan have to reorganize in order to get the 20%? It's going to raise his operating costs because he's no longer going to have just one payroll operation and one line of credit and all the different things that he works through the LLC. Or is Treasury going to recognize that this situation is extremely common and that he should be able to aggregate the rules? They have existing rules. They're under 469 of the code. They've already dealt with this through the statutes and regs and legal cases. So they already have a broad means of determining who could be able to aggregate and who can't. And to Doug's point, though, the beauty of it is not only does it make sure that Dan gets the deduction that he should as a manufacturer out there creating lots of jobs, but it also gives Treasury the rules so that they can go after the crack and pack. Because the challenge with the 20% deduction is not people gathering together businesses to get more of a deduction. I don't know of a scenario where that would work. Where it's going to happen is where they try to break up a law firm or other specified services businesses in order to get like activities that might qualify and get a deduction for those. Well, the aggregation rule gives Treasury the ability to look at that and say, that's not an appropriate disaggregation of your business. We're going to aggregate this. This is a law firm. Who are you kidding, right? It's a law firm. You're going to get treated like a law firm. You don't get the deduction. So it really gives Treasury the rules to go after the bad actors, and it makes sure the businesses that are legitimately organized with lots of entities get the deduction that they deserve.
Can I ask a question?
Yeah, no, I got it.
It's just I've always wanted this, and until today I never thought, look, we always talk about pass-throughs, and you're mostly interested in the S-corps. We know that more than half of business income is in pass-throughs. How much is S-corps of that, and how much do we have to worry about LLCs and other entities? Do you know?
I don't.
I
I think
Homework
escorts
assignment.
It's knowable.
I think escorts about a quarter.
One of our older reports.
I know
Yeah.
employment escorts are.
I don't want to say numbers I don't know, but I think a lot of, if you measure by income, a lot of it is in financial industry partnerships, if we pass through income. Yeah, but those are going to be largely service businesses. And so one last question for Doug, and then we'll open it up. Doug, you talked about the goal of this being to drive growth. In your view, does growth is more likely to come from publicly traded or pass through from large or small? Like, should we care? Do we know that any of those indicators are what really drives growth?
we shouldn't care. And the economics of it are that we lay out a set of neutral incentives and let whoever can deliver the growth deliver it by being successful. In the data, there's an enormous amount that's to be said for this model. So in the late 90s, half of the productivity boom was big box retail. I didn't see that coming, suddenly that mattered a lot. So we're not smart enough to know what it's going to be. You just want to have neutral incentive there, let it appear. But you certainly don't want to stack the deck against people who are starting out.
Okay, who's got questions out there? Steve?
I was wondering about the assumption that so many of the lenders are tax exempt. And I doubt very much that they're the marginal lender. So I'm wondering what your number would look like if you didn't treat them as tax exempt. And here's the reason. The pension fund and the 401k and so forth are taxed eventually on distribution, and they've grown and they're being taxed with interest, and there's some less acceleration in tax, but generally speaking, you have to treat them the same way you did the capital gain, which is eventually taxed. And you discounted it, but there's been some growth there too. I'm not sure you've taken that into account, so it wouldn't happen if you hadn't given a deferral. So I think those things are not correctly described as tax exempt or tax deferred.
Yeah,
And the second point, though, is on the foreigner and the wealth funds abroad. These are hardly the marginal lenders. They can't simply vary the amount they're going to be putting into their saving if it's tied to the oil profits of the national oil company. This is not something that's discretionary. If these are not marginal lenders, then the business borrowing the money from somewhere is not getting a break for them, and it is not lowering their cost of capital. So we get back to Doug's point that I want the marginal cost of funds. And so I'm just curious what that 30.6 number looks like if you don't make that assumption that this amount is tax exempt. I think that's the economically correct approach.
Yeah, I think I would answer this the same way I've heard many other people answer this. I remember when I was working at CEA, Glenn Hubbard, who was at the chair of the CEA at the time, was testifying before the House, the Senate Budget Committee, and Senator Corzine asked him actually a similar question. You know, you've assumed, you've made a particular assumption about who might be the marginal investor, and I think the response, reasonable response is, I have no idea who the marginal investor is. And so for these sorts of analyses, it's not uncommon. It's probably more common than not to kind of assume, you know, kind of use the average as the, I don't know who the marginal investor is, so I'm going to use a composite of all investors. So what we've done here, to your point about deferral and so on, you know, within retirement accounts, pension funds, with respect to individual retirement accounts, the upfront deduction is usually thought to completely offset the taxes due upon distribution on the normal return, at least. With Roth IRAs, it's kind of a clearer, Roth IRA treatment is kind of a much clearer view on how that operates.
Kyle Pomelo Tax Foundation. So the CBO actually did an analysis like this earlier this year where they looked at the marginal effective tax rates, and not just by business form, but by asset type. So it wasn't looking at, say, the average C corporation, but it was looking at, you know, what would happen if you put a machine into a C corporation, what would the rate be there? What would, if you put it into a pass-through business, what would the rate be there? And across the board, they found that assets placed in the pass-through form were at a slight advantage while Section 199 was in place. From your perspective, anyone can take this, which method of measurement here, marginal effective tax rates or average tax rates, do you think is more important in determining broad range of behaviors, whether it's entity choice or investment behaviors?
I'm happy to jump in there, Bob. One of the challenges that we have in measuring all these things is that, you know, C Corp income tends to be earned by very large companies, all paying at the top rate. Pass-through income, as you'd imagine, is much more spread out over the income ranges. So you have a lot of small S-corps and pass-throughs and sole props, et cetera, earning little amounts of money and paying low marginal rates. So a lot of what you see in the CBO analysis, a lot of what you see in the Treasury analysis, is driven, the low rates on those pass-through assets is driven by the smaller guys paying the lower rates in the progressive income scale. So I think that's part of the challenge is what we're looking at here are companies that are paying the top rates. So we're comparing apples to apples, top rates to top rates.
Except for the C corporation where you do an average just like that.
No, what we're doing is assuming different profiles for shareholders. That's the question that Steve got at, and Bob, I think, answered it very well, which is, I don't know who the marginal one is. And frankly, I think it's completely absurd to say, I'm a public company, I have access to all these sovereign funds, et cetera. Those guys don't pay taxes. My cost of capital is going to be exactly the same as a company that is locked in and has to earn or raise money from fully taxable individuals. It's not.
Anyone?
Comment? I think on the average C corporation, a couple things you left out that would lower the C corporation rate are 1202 stock that's available to small businesses. I don't know if you took, obviously capital gains realized at death would have you didn't take that into account, so that would lower that number as well. So I just wanted to make that point.
Yeah, 1202 could be a very big issue for
Yeah, for people who, for people who
a very big
don't,
issue for C corporations because it could wipe out a large part of the second layer of tax.
yeah, 1202.
And that's something for purposes of brevity, we didn't go into here, but it will be, it is something.
It's sort of a,
1202 is
it's a sleeper provision that was instituted in law in 1993 to help small businesses grow. Nobody really uses it until now. It's going to get a lot more attention, so we don't know the extent.
Yeah, it's something that's getting a lot of attention now.
Let me ask one more, because I have not yet seen much evidence of conversions one way or the other. I'm just curious if any of you have seen, you would seem to think that if the market writ large were really adjusting the parity, relative parity of pass-throughs and C corps, that we'd start to see conversions from in one direction or another. And I'm just curious if you've seen anything like that.
I'm sure Brian has a perspective, but I'll just say beforehand that there are an awful lot of companies that are running the numbers. They're clearly running the numbers. They want to know whether they should consider converting, whether it's a partnership, a C corp, S corp. They're running the numbers in multiple ways, looking at different facets, different parts of their business to see how they ought to restructure. Some may have foreign operations, some might not, and certainly there's just an awful lot of work and modeling that companies and those who advise those companies are doing around these issues. Absolutely.
And Richard. And the other piece, that's the obvious piece, which is until the Treasury actually finalizes these regs and the stuff on the, especially the international side of the C corp, they're just going to make money running numbers. No one will actually convert.
It's true. So a couple thoughts. One, when we are seeing S corps converted, we have had a number of folks that we've worked with in the past have converted to C already. Two, in the bill there is a 2-year conversion sort of safe harbor that gives S corps a more friendly set of rules if they convert within the next 2 years, so this year in 2019. I expect that the combination of that 2-year rule and sort of the folks are waiting to see what the rules are coming out of Treasury. You'll see once the rules come out, people will rerun the numbers based on the new set of rules, and then you'll probably see the number of conversions next year too. I don't know that Ben Wharton did a paper on sort of mass conversions expected, and I think they estimated about 250,000 S corps would convert to C in the next couple of years. One, I'm not sure how mass that is. There's almost 5 million S corps out there. Two, I think it's largely going to be where you would expect to see it, which are the specified services businesses, doctors, lawyers, etc., who don't have to worry about the rules because they ain't going to get the deduction. There, as Bob showed, are paying high marginal rates and probably higher marginal rates than if they converted to C. So my expectation is that to the extent that you see a large number of people converting these days, it's going to be doctors and lawyers. And effectively all we've done is gone back to pre-86 when all those rich professionals were using the C corp as a tax shelter. And we're going to be back in that model again. And then we're going to have to start working on sort of the personal holding company rules and all that sort of stuff. We're going to go right back to where we were before 86.
That's your note.
Well, some people have referred to the conversion question. It's either, because once you switch, it's really hard to go back. it's either the Hotel California or Roach Motel, pick your metaphor. So there are upsides and downsides. So thanks for everyone for coming to the event today. Business taxation has gotten complicated, but one thing for clear, pass-throughs, getting the 20% deduction is really a make or break question. As we said before, that's why it's essential that we get some good rules out of the Treasury and that Congress acts to make these rules permanent. And don't forget on your way out, the packet that Doug was referring to has all the handouts from today's event and the full EY study. So those are available at the table on the way out. Thanks again for coming.
Oh, God, that was, yeah. So in the late 90s, half of the productivity boom was big box retail. Didn't see that coming, suddenly that mattered a lot. So we're not smart enough to know what it's going to be. You just want to have mutual incentive to let it appear. But you certainly don't want to stack the deck against people who are starting out.
Okay, who's got questions out there? Steve?
I was wondering about the assumption that so many of the lenders are tax exempt. And I doubt very much that they're the marginal lender. So I'm wondering what your number would look like if you didn't treat them as tax exempt. And here's the reasoning. The pension fund and the 401k and so forth are taxed eventually on distribution, and they've grown and they're being taxed with interest, and there's some less acceleration in tax, but generally speaking, you have to treat them the same way you did the capital gain, which is eventually taxed. And you discounted it, but there's been some growth there too. I'm not sure you've taken that into account, so it wouldn't have happened if you hadn't given the deferral. So I think those things are not correctly described as tax exempt, they're tax deferred.
Yeah,
And the second point, though, is on the foreigner and the wealth funds abroad. These are hardly the marginal lenders. They can't simply vary the amount they're going to be putting into their saving if it's tied to the oil profits of the national oil company. This is not something that's discretionary. If these are not marginal lenders, then the business borrowing the money from somewhere is not getting a break for them, and it is not lowering their cost of capital. So we get back to Doug's point that I want the marginal cost of funds. And so I'm just curious what that 30.6 number looks like if you don't make that assumption that this amount is tax exempt. I think that's the economically correct approach.
Yeah, I think I would answer this the same way I've heard many other people answer this. I remember when I was working at CEA, Glenn Hubbard, who was at the chair of the CEA at the time, was testifying before the House, the Senate Budget Committee, and Senator Corzine asked him actually a similar question. You know, you've assumed, you've made a particular assumption about who might be the marginal investor, and I think the response, reasonable response is, I have no idea who the marginal investor is. And so for these sorts of analyses, it's not uncommon, it's probably more common than not to kind of assume, you know, kind of use the average as I don't know who the marginal investor is, so I'm going to use a composite of all investors. But what we've done here, to your point about deferral and so on, you know, within retirement accounts, pension funds, with respect to individual retirement accounts, the upfront deduction is usually thought to completely offset the taxes due upon distribution on the normal return, at least. With Roth IRAs, it's kind of a clearer Roth IRA treatment. It's kind of a much clearer view on how that operates.
Kyle Pomerleau Tax Foundation. So the CBO actually did an analysis like this earlier this year where they looked at the marginal effective tax rates, and not just by business form, but by asset type. So it wasn't looking at, say, the average C corporation, but it was looking at, you know, what would happen if you put a machine into a C corporation, what would the rate be there? What would, if you put it into a pass-through business, what would the rate be there? And across the board, they found that assets placed in the pass-through form were at a slight advantage while Section 199 was in place. From your perspective, anyone can take this, which method of measurement here, marginal effective tax rates or average tax rates, do you think is more important in determining broad range of behaviors, whether it's entity choice or investment behaviors?
I'm happy to jump in there, Bob. One of the challenges that we have in measuring all these things is that C Corp income tends to be earned by very large companies, all paying at the top rate. Pass-through income, as you'd imagine, is much more spread out over the income ranges. So you have a lot of small S Corps and pass-throughs and sole props, et cetera, earning little amounts of money and paying low marginal rates. So a lot of what you see in the CBO analysis, a lot of what you see in the Treasury analysis, is driven, the low rates on those pass-through assets is driven by the smaller guys paying the lower rates in the progressive income scale. So I think that's part of the challenge is what we're looking at here are companies that are paying the top rates. So we're comparing apples to apples, top rates to top rates.
Except for the C corporation where you do an average just like that.
No, what we're doing is assuming different profiles for shareholders. That's the question that Steve got at, and Bob, I think, answered it very well, which is, I don't know who the marginal one is. And frankly, I think it's completely absurd to say, I'm a public company, I have access to all these sovereign funds, et cetera. Those guys don't pay taxes. My cost of capital is going to be exactly the same as a company that is locked in and has to earn or raise money from fully taxable individuals. It's not.
Anyone?
Comment? I think on the average C corporation, a couple things you left out that would lower the C corporation rate are 1202 stock that's available to small businesses. I don't know if you took, obviously capital gains realized at death would have you didn't take that into account, so that would lower that number as well. So I just wanted to make that point.
Yeah, 1202 could be a very big issue for
people who don't.
Big issue for C corporations because it could wipe out a large part of the second layer of tax.
Yeah, 1202.
And that's something for purposes of brevity, we didn't go into here, but it is something.
It's sort of
it's
a sleeper provision that was instituted in the law in 1993 to help small businesses grow. Nobody really uses it until now. It's going to get a lot more attention, so we don't know the extent.
Yeah, it's something that's getting a lot of attention now.
Let me ask one more, because I have not yet seen much evidence of conversions one way or the other. I'm just curious if any of you have seen, you would seem to think that if the market writ large were really adjusting the relative parity of pass-throughs and C corps, that we'd start to see conversions from in one direction or another. And I'm just curious if you've seen anything like that.
I'm sure Brian has a perspective, but I'll just say beforehand that there are an awful lot of companies that are running the numbers. They're clearly running the numbers. They want to know whether they should consider converting, whether it's a partnership, a C corp, S corp. They're running numbers in multiple ways, looking at different facets, different parts of their business to see how they ought to restructure. Some may have foreign operations, some might not, and certainly there's just an awful lot of work and modeling that companies and those who advise those companies are doing around these issues. Absolutely. And Richard.
And the other piece, that's the obvious piece, which is until the Treasury actually finalizes these regs and the stuff on the, especially the international side of the C Corp, they're just going to make money running numbers. No one will actually convert.
That's true. So a couple thoughts. One, we are seeing S corps convert. We have had a number of folks that we've worked with in the past have converted to C already. Two, in the bill there is a 2-year conversion sort of safe harbor that gives S corps a more friendly set of rules if they convert within the next 2 years, so this year in 2019. I expect that the combination of that 2-year rule and sort of the folks are waiting to see what the rules are coming out of Treasury. You'll see once the rules come out, people will rerun the numbers based on the new set of rules, and then you'll probably see the number of conversions next year too. I don't know that Penn Wharton did a paper on sort of mass conversions expected, and I think they estimated about 250,000 S corps would convert to C in the next couple of years. One, I'm not sure how mass that is. There's almost 5 million S corps out there. Two, I think it's largely going to be where you would expect to see it, which are the specified services businesses, doctors, lawyers, etc., who don't have to worry about the rules because they ain't going to get the deduction. There, as Bob showed, are paying high marginal rates and probably higher marginal rates than if they converted to C. So my expectation is that to the extent that you see a large number of people converting these days, it's going to be doctors and lawyers. And effectively all we've done is gone back to pre-86 when all those rich professionals were using the C Corp as a tax shelter. And we're going to be back in that model again. And then we're going to have to start working on sort of the personal holding company rules and all that sort of stuff. We're going to go right back to where we were before 86.
That's your note.
Well, some people have referred to the conversion question. It's either, because once you switch, it's really hard to go back. It's either the Hotel California or Roach Motel, pick your metaphor. So there are upsides and downsides. So thanks for everyone for coming to the event today. Business taxation has gotten complicated, but one thing for clear, pass-throughs, getting the 20% deduction is really a make or break question. As we said before, that's why it's essential that we get some new rules out of Treasury and that Congress acts to make these rules permanent. And don't forget on your way out, the packet that Doug was referring to has all the handouts from today's event and the full EY study. So those are available at the table on the way out. Thanks again for coming.